हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है बिजनेस कॉम्बिनेशन, दैट इज इंडियन अकाउंटिंग स्टैंडर्ड 103 पार्ट 3. In previous two parts we had discussed about the definition of business. What is business? Business is an integrated set of activities in order to generate the profit of the organization, in order to generate the output, in order to generate the interest income, in order to generate the income of the organization. The entity has to do the business by inserting the different elements of business. Like elements, we have to insert the input, then we process in order to generate the output means the income of the organization in the form of profits, in the form of dividend, in the form of interest income. Like these are the outputs of the organization. So we had discussed in the previous class that the what is the definition of business, what are the different elements of business. Then we had discussed the business combination, why business combination is done. If one entity acquire another entity and control over the another entity, then that combination is to be said as a business combination. Combination is done in many ways, like in the form of merger, in the form of amalgamation, in the form of asset acquisition. The scope in India's 14 is limited, that they have discussed only about the merger and amalgamation. They do not discuss about the asset acquisition. But in business combination, the scope is very wider. It discussed about the merger also, it discussed about the amalgamation also, it's discussed about the asset acquisition, different steps in the asset acquisition. Then what is the definition of control? We had discussed in the previous example, in previous class, that what is control. Control is defined as per Ind AS 110, that if one entity has the power to acquire the control over the another entity, then that entity who has the power to acquire the another entity, power to appoint the KMPs of the another entity, powers to remove the KMPs of the another, power to have the potential voting rights, power to have the voting rights, and in order to earn the profits, and have the power to chase the profit of the another entity, then that entity is having a control over the another entity. Then we had discussed about the what is the substantive process. Substantive process is to enhance. If there is no means output is there, but the entity is having a capability to earn the profit by having the input, by having the processes, then that process is still said to be a substantive process. Means that entity has the ability to earn the profit even they don't have the profit right now. So that process is said to be as a substantive process. Then we had discussed about the concentration test. That is not mandatory. Still the people are doing the concentration test. That is gross asset is concentrated to the asset or a group of assets. Then we had discussed about transaction cost. Then we had discussed about the asset acquisition. Asset acquisition is that method where the entity acquire only the asset of the organization, not the liability. The purpose of taking that entity is that fixed asset only. The purpose of doing business combination with that entity is that because that entity is having a fixed asset, that is the land. The value of the land they're paying is more than 90% of that land they have. So that case is the case of asset acquisition. Then we had also discussed about the difference between the business combination and asset acquisition. Asset acquisition, in which the asset is only acquired. India 16 is to be followed. The goodwill is not recognized in case of asset acquisition. But in case of business combination, it is a merger, it is an amalgamation. The scope is wider in business combination, the scope is limited in asset acquisition. India 16 is applied in asset acquisition, but in business combination, India 103 is applied. And goodwill is to be recognized in case of business combination, but goodwill is not recognized in case of asset acquisition. In case of business combination, all the assets and liabilities, deferred tax liabilities, etc., is to be recognized, is to be taken by the entity at fair value. But in case of asset acquisition, only the asset is acquired, not the liability, not the deferred tax liability, and goodwill is also not recognized. Then we had discussed about the different methods of business combination. There's two business combination method, that is the acquisition method and the common control method. What is an acquisition method? Where an entity acquire another outside the group, where an entity acquire another entity outside the group. That method is called as an acquisition method. Then we had discussed the common control method, that is when an entity acquire another entity within a group, then that transaction is said to be a common control transaction. These are the two methods of business combination. They are, if an entity acquire any another entity of within a group, that is the common control method. And if an entity purchase or acquire another entity outside the group, then that method is the acquisition method. Acquisition method is in the form of merger, in the form of amalgamation, in the form of acquisition, in the form of any other methods. So today we are going to discuss about the steps in the acquisition method. There are various steps in the acquisition accounting. Steps in acquisition accounting. What step is to be followed while doing an acquisition account? So step 1 is identify the acquirer. Then step 2 is determine acquisition date. Then step 3 is determine purchase consideration. Then step 4 is recognize all the assets and liabilities assumed. Then step 5 is recognize hidden intangibles. Then step 6 is recognize non-controlling interest. Then step 7 is recognize goodwill or bargain purchase or gain. Then recognize deferred tax. These are the steps of acquisition account. First step is identifying the acquirer. That is who purchased the business. Firstly, the entity has to identify the acquirer, the person who is purchasing the business. Acquirer is the enterprise who acquired the control on other business or entity. Means the acquirer is the enterprise who acquire another entity or the business of another entity. Control needs to be determined as per Ind AS 110. That is, as per 110, the control, the definition of control is as per Ind AS 1110. Business combination accounting needs to be done in the books of acquirer. So acquirer, who is the acquirer? Who acquired the business, who have the control over the business, and accounting is to be done in the books of acquirer only. Now note, business combination accounting needs to be done in consolidated financial statement. But in case of merger, amalgamation, acquisition, combination accounting needs to be done in standalone. Generally, business account combination accounting needs to be done in consolidated financial statement, but in case of merger, in case of amalgamation, business combination accounting needs to be done in standalone financials. Means in case of transaction cost, in case of standalone financial statement, it should be capitalized with the value of the asset, but in case of consolidated financial statement, it should be charged to P&L in case of business combination accounting. But if it is a case of merger, if it is a case of amalgamation, then no need to prepare means consolidated financial statement. The transaction cost is to be charged to profit and loss account separately in case of merger and amalgamation, because what happen in case of merger, they are acquiring that merging that another entity in their own entity, and there is no existence of that another entity. If there is no existence of that another entity, then there is no matter of preparing a CFL. All the adjustments is to be done in standalone financial statement. If amalgamation is done, in case of amalgamation, what happened? When two entity merge together to form a one entity, to form an amalgamate with each other and form a one entity, then in that case only standalone financial statement is to be prepared, because if two entity merge together and become a one entity, then there is no existence of that two entity also. Only the existence of one entity is left. Only standalone financial statement is to be prepared, and all the adjustments is to be done in standalone financial itself only, in case of merger, in case of amalgamation, and in case of acquisition of asset also. Because in acquisition of asset, what happened? We are not acquiring the whole business, we are acquiring the asset of that organization. So in that case also adjustment is to be done in standalone financial statement. But what is business combination needs to be done in case of consolidated financial statement, when the relationship between the holding and subsidiary forms, when the relationship between the holding and associate forms, when the relationship between the holding and joint venture operations is forming, when joint venture accounting is to be done, then in that case the consolidated financial statement is required to be prepared. Then in that case adjustment is required in case of consolidated finance. Then two separate accounting is to be done in the standalone also in the consolidated financial statement. And if there is no existence of another entity, then only standalone financial statement is to be prepared. So these are the concepts which we had discussed in the previous discussion also. Now we will take some scenarios, some examples in order to clarify our discussion. Like A Limited is a company who acquired B Limited, who acquired the business, that is B1 is the business of B Limited, which is not a separate legal entity. B is a separate legal entity. B Limited itself is a separate legal entity. B Limited is having a three subsidiary, that is three business he is having, that is B1, B2 and B3. And A Limited is acquiring one of the business of B Limited, which is not a separate legal entity. A Limited is acquiring the business of B Limited, and B Limited has three business, that is B1, B2 and B3. And that business are not a separate legal entity, because they are not acquiring the separate legal entity, and they are not forming also the separate legal entity. They are merging that with their business on, and there is no existence of that business left. So in that case, A Limited is required to prepare only the standalone financial statement, because it includes the B1 business in its own business, and there is no existence of B1 business as of after acquiring that business. So in that case, only standalone financial statement is required to be prepared. No requirement to prepare consolidated financial statement, because A Limited is not existence of separate legal entity. Now scenario 2, when the A Limited is a company who purchased the business of B Limited, that is one of the business of B Limited, and form a new separate legal entity. In that case, A Limited is acquiring the business of B Limited, one of the business of B Limited, and creating another new separate legal entity. In that case, it has a two separate legal entity, A Limited and the business one is also, he is forming another separate entity. In order, after acquiring the business of B Limited, he is creating another separate legal entity. In that case, there is the existence of two companies, that is A Limited and business one. Business combination accounting is to be done in the consolidated financial statement, because in previous example there is no existence of B1. It is, there no existence left of B1, because it is totally merged with A Limited. But in another example there is an existence of B1, because B1 is itself is a new separate legal entity. business combination accounting is to be done in consolidated financial statement and not in the standalone finance. Was the definition of control as per Ind AS 110. So if any entity is having a controlling power over the another entity, in that case, the person who is having a controlling power is become an acquirer. Control encompasses three distinct principles. That is, firstly, the power. Secondly, the exposure or rights to the variable returns from its involvements with the investee. And thirdly, the ability to use its power over the investee to affect the amount of investors' return. So control encompasses three distinct principles which, if present, identify the existence of control by the investor over an investment, hence forming a parent-subsidiary relationship. Suppose H Limited acquired 80% stake in A Limited and 20% is acquired by B Limited, that is non-controlling interest. Now who is the controller over in this case? Who has the power over the investee? Who has an exposure or rights to variable returns from its involvement with the investees, and who has the ability to use its power over the investee to affect the amount of investors' return. So what is the power? What power they have to control the investee? What power the investor is having to control the investee in order to become the acquirer? So the example of power means having voting rights in the investee's company. If the investor is having a voting rights in the investee company, he is having a control over that company. If they are having a potential voting rights in the investee's company, potential voting rights means they have a right in future, that they will get right in future in the investee's company, so they are the potential voting rights. If they have a rights to appoint KMP of the investee's company, if they have a power to appoint KMPs of the investee company, power to remove KMP of the investee's company, even investor company has a power to appoint key managerial personnel of the investee's company, then in that case they have a controlling power over the investee's company. Even investor company have the power to remove the key managerial personnel of the investee company. They have a power or the controlling power over the investee's company. If the investor has the power to decide managerial remuneration of the key managerial personnel of the investee's company, if they have a power to sell and purchase the product of the investee's company, if they have a right to do the research and development activities of the investee's company, then these are the power, these are the controlling over the investee's company. Who are the KMPs? KMPs are the managing director, whole-time director, manager, chief executive officer, chief financial officers, chief technical officers, chief strategic officers. These are the, firstly they have the power over the investee, then they have the exposure or rights to variable returns from its involvement with the investee's company. They have a rights to receive the remuneration distributed by the investee's company. They have rights to receive over the profits of the investee's company. They have rights over the dividend which is distributed by the investee's company. They have a rights to receive the interest income of the investee's company. In that case, they have a controlling power over the investees company because they have a power of voting rights, and they also have the power to receive income of the investees company. They have the rights to receive the remuneration, rights to receive the profits, rights to receive the dividend, right to receive the interest income of the investees company. And also they have the ability to use their power, use the its power over the investee company to affect the amount of returns which they are distributing So investor has the power which significantly change or affects the amount of profits or returns distributed by the investees to the investor or a holding company. The person or the entity who has all these principles, they are treated as a controlling power, and thus they are forming a parent subsidiary relationship. If they have an ability to change or to affect the profits of the investees company by making a decision made by them, then in that case they are having a power, controlling power over the investments of the investees company. This creates a relationship parent subsidiary. Now potential voting rights means the rights which are available in the future by the holder of the, means which are available to the holder of the, not in present, in future they become, if they are having today, they are having a convertible debentures, they are having a convertible bond, they are having a convertible preference share which becomes an equity share in future. So they have a potential right today to become a voting right in future. So needs to be considered for evaluation of control. So these rights also are to be considered for evaluation of. Now H Limited are the manufacturer of textile who acquired 20,000 equity shares of company X. As a part of the same agreement, H Limited purchased an option to acquire 20,000 shares of X Limited in future, and that is in next 12 months. The exercise price includes a small premium to the market price. After the above transaction, the shareholders of X Limited is having other shareholders, that is I Limited, who holds 40,000 shares of X Limited and also has currently exercisable option to acquire additional 40,000. Now evaluate the controlling entities of X Limited. Who is the controlling entity in both? In this case, now solution becomes particular H Limited, who has an existing shares of 20,000 and potential shares. Potential to acquire an option in future becomes 20,000 shares. So he is having existing shares of 20,000 and potential in the next 12 months he will acquire 20,000 shares of X Limited. So existing share plus potential share, total share become 40,000. So potential share is also considered while calculating the controlling over the entity. And I Limited is also having a 40,000 shares. Presently he is having a 40,000 shares of X Limited and potential to acquire in future the additional 40,000 shares. Now total is having 40,000 and I Limited is having 80,000. Now percentage is to be calculated, like 40 divided by 120 it becomes 33%, and I Limited is having a 77%, which is more than 50%. So it creates a holding subsidiary relationship between the X Limited and I Limited. So I Limited is the acquirer in this case because he is having the 77% stake in X Limited. So I is the acquirer in this case subject to other factors as mentioned in the definition of control under Ind AS 110. So he is having a controlling power subject to the other factors like power over the investees, and then generate the variable returns of the investees, then he have the power to change the returns of the investees. So in that case I Limited is the acquirer subject to other factors as mentioned in the definition of control as per Ind AS 110. Illustration: X Limited will form a company Y Limited who has taken a loan from bank to purchase 100% voting rights at fair value of Z Limited. Means in this case what happened? X Limited form a company which is called Y Limited, and Y Limited what happened has taken a loan from bank in order to purchase Z Limited, in order to purchase 100% stake voting rights in Z Limited. So X Limited form another entity, legal separate entity, Y Limited. And what Y Limited has done, he has taken a loan from bank in order to purchase 100% stake in Z Limited. Now, as Y Limited acquired Z Limited, Y Limited is having a voting right. He has the rights to appoint the governing bodies. He has the rights to remove the majorities of the members. He has the power to vote. He has the power to dominate. Now, in these cases, Y Limited shall be identified, because who has fulfilled the definition of control as per Ind AS 110 is the Y Limited. And Y Limited shall be identified as a acquirer, because he has all the rights of Z Limited. So Y Limited becomes the acquirer. Will determine the acquisition date, which date is to be called as a acquisition date. Acquisition date is the date on which the acquirer has acquired the control over the business, control over the investees. The date on which the acquirer has acquired control over the investee, that date is to be called as an acquisition date. Acquisition date will be the effective date on which the acquirer obtain control over the investee. So, effective date shall be the date on which the acquirer has transferred the fund or obtained the control of the asset. Regulatory approval, if any regulatory approval needs to be obtained in order to obtain control, effective date shall be the date on which approval needs to be obtained. No binding agreement between the purchaser and the seller. If there is or no binding agreement between the purchaser and seller, business combination cannot be done. So in order to become a business combination, there is an agreement between the purchaser and seller, which will be a binding agreement. If there is no binding agreement between the purchaser and seller, it is not called as a business combination. And in order to become the effective acquisition date, approvals, regulatory approval needs to be required in order to obtain the control over the investees. And before approval date, if you had acquired or transferred the fund or obtained the control, so in that case, it is not the acquisition date. Acquisition date is firstly when you had obtained the control, then you have transferred the fund, then you have obtained the control of the asset. And if you have not obtained the regulatory approval, then that date is not be called as effective date. And in order to become effective, they have to obtain the regulatory approval if required. Then after that only business combination acquisition date is to be. So illustration related to non-binding sign letter. If there is a non-binding sign letter, suppose A Limited purchase a stake in S Limited, that is non-binding agreement signed by both the parties. When we do business combination accounting in case of non-binding agreement, non-binding agreement means any party has the ability to terminate the contract. No penalty applicable in case of termination. Then business combination cannot be done in case of signed non-binding agreement. If there is a non-binding agreement, business combination cannot be done, because in that case any party can terminate the contract any time and no penalty exists. So there is no fear of that. They will terminate the contract at any time. So in that case, this is not a case of business combination. Suppose A Limited will get effective control over B Limited on 1st April 2020. Effective control means assets, liabilities, business, decision making activities. On 30th April 2023, A Limited will get shareholders approval and funds to be transferred in future. In that date, the fund is not transferred, only approval is taken from the shareholder and fund is to be transferred in future. In that case, acquisition date will be 1st April 2023. That is the date of effective control and not the date of approval, because on 1st April 2023 itself, the assets, liabilities, business and decision making activities is to be transferred by B Limited to the A Limited. It is said that The A is having an effective control over B Limited on 1st April 2023 itself. So business combination can be done on the acquisition date, that is on 1st April 2023 and not on 30th April 2023. Approval is not required in order to become an effective control. On 30th April 2023, if A Limited will not get an approval and purchase is to be made in cash, they are paid 100% cash, in that case also, but they have an effective control on 1st April 2023 itself, because they had acquired all the assets, liabilities, decision making activities and business of B Limited on 1st April 2020. So the date of effective control and not the date of purchase when they had made the payment. So business combination can be done on the acquisition date, that is on 1st April 2020. Now illustration. PM Limited has the power to acquire 100% acquisition of RD Limited. Negotiation commenced on 1st January 2024. As per the negotiation agreement, what happened? Acquisition is effective and PM Limited entitled to profits on 1st January 2024 on the date of negotiation. As per the negotiation agreement, acquisition is effective and PM Limited entitled to profits on 1st January 2024. Purchase price consideration is decided based on the balance sheet and profit and loss as at the 1st January 2024. Finalization of agreement and obtaining power on operation, that is control, on 4th April 2024. What is the acquisition date of PM Limited on RD Limited? Now, on 1st January 2024, they had negotiated, they had decided and also entitled to profits on 1st January 2024. They also decided the purchase consideration what they had paid based on the balance sheets and profit and loss. But finalization of agreement and obtaining power on the operations of the RD Limited. Now in that case, what is the acquisition date? Acquisition date is the date, not the date of negotiation. It is the date when they actually get the power to control the operation of RD Limited. That is on 4th April 2024. That is the date of controlling of RD Limited by PM Limited as per the definition of acquisition date as per Ind AS 10. They actually obtain the control over the operations of the RD Limited. That date is the date of acquisition. Now, P Limited are the manufacturer of rubber component and the same component is manufactured by XYZ Limited. P Limited has applied a bid offer to acquire XYZ Limited. The Competition Commission of India announces that the proposed transaction is to be scrutinized to ensure that the competition losses were not breached, even though the contract were made subject to approval of the CCI. P Limited and XYZ Limited mutually agreed that the terms of acquisition and purchase price before the competition authority clearances is obtained. Can the acquisition date is these in this situation can be the date on which P Limited and XYZ Limited agreed the terms even though CCI approval is awaited and can do business. In the above situation, CCI approval is pending and business combination cannot be done before the approval of CCI even though the purchase consideration assets liabilities has been obtained by the parties before approval of CCI. So approval is required, approval is mandatory. After approval, the date when they get the approval is the acquisition date, not the date when they acquired, they mutually agreed the terms and the purchase prices, all that date is not the acquisition date. The date when they actually get the CCI clearances, that date is the acquisition date. Before that date, no business combination is to be done. We had determined the acquirer, we had determined the acquisition date. Now we are determining the purchase consideration. Purchase consideration can be discharged through cash payment, asset transferred, assuming liability. Purchase consideration should be recognized at fair value. In issuing equity shares, purchase consideration should also be recognized at fair value. In contingent consideration means it should be payable only on the occurrence and non-occurrence, only on the occurrence and non-occurrence of the future. That consideration, contingent consideration, is to be payable only when there is an occurrence and non-occurrence of future events. For example, if payment is to be made for additional 20 crores, payment of additional 20 crores if the profits become twice after 2 years. Additional payment should be done if company obtain any pending regulatory approvals, patents or license in future. So in that case, additional amount is to be paid. It depends on the occurrence or non-occurrence of the future events. That consideration. Contingent consideration is also recognized at fair value, and deferred consideration means the consideration is to be paid in future period. Such deferred consideration shall be recognized at fair value. Means deferred consideration is that kind of consideration which is decided today but paid in future, and contingent consideration is depend on the occurrence and non-occurrence of the future event. Deferred consideration is that consideration which is already decided today but it will be payable in future, and it should be recognized today at a fair value. Now illustration. Suppose R Limited acquire A Limited, that is holding company, at rupees 2 crores. Cash payment is to be done in 1 crore today, and deferred consideration is to be paid 1 crore in future after 2 years. So how we will recognize that? We will take the cash payment as a whole 1 crore as purchase consideration, plus we will find out the present value of the deferred consideration today, what we will pay in future. So present value of the purchase consideration plus cash payment plus deferred. Now we will compute the present value of deferred consideration by which is paid after 2 years. So 1 crore is paid after 2 years. We will pull discounting rate, that is 0.826 after 2 years. So we will bring it out at present value today. So it becomes 82,60,000. So purchase consideration 1 crore plus, that is cash payment, plus 82.60, so 1.8260 crores. Now the net asset acquired at fair value is 1.40 crores. So goodwill will be the differential amount 0.4260 crores. So in today's discussion, we will discuss how to compute goodwill. That is, we have to determine the purchase consideration. That is, the purchase consideration includes the cash, the assets and liabilities transferred, then equity shares, contingent consideration, then deferred consideration. All should be at fair value. These are the different methods of discharging the purchase consideration, that is in the form of cash, in the form of assets, in the form of liabilities, then equity shares, then contingent consideration, then deferred consideration. All should be recognized at fair value. Then what comes? Net purchase consideration, and from that net purchase consideration, the net asset acquired which is at fair value is to be reduced. From purchase consideration, the net asset acquired at fair value is reduced. The difference between the purchase consideration and net asset acquired is the goodwill or bargain purchase gain, if any. Bargain purchase gain means it is a kind of capital reserve. When the net asset acquired is more than purchase consideration, then it is a case of bargain purchase gain. When an net purchase consideration is more than net asset acquired, then it is a case of subsequent recognition and measurements of contingent consideration. We had discussed about the contingent consideration. What are the initial recognition of contingent consideration? Contingent consideration means it's depend on the occurrence or non-occurrence of the future events. There is some difference between the liability and equity contingent consideration, as we had discussed in our financial instrument standard, Ind AS 107, 109 and Ind AS 32. What we had discussed, that in case we are recognizing the liability, then what happened? When should an entity recognize that liability? That it is a nature of liability when there is a contractual obligation to pay cash in future. Then that if there is a contractual obligation to pay cash in future, that they need to pay cash in future, then they will recognize that liability initially at fair value. Then it is a liability when fixed to fix get fail. In case of convertible instrument settlement through own equity shares where fixed to fix get fail. Means if settlement happen in own equity shares when fixed to fixed criteria get failed and when there is a contractual obligation to pay cash, then in that case it is a nature of liability. Initially it should be recognized at fair value and subsequently it should be recognized at fair value and recognized through profit and loss account. And if it is a case of equity, if it is in the nature of that consideration is in the nature of equity, then what condition needs to be checked? That equity is what happened. Equity is given at the end to the shareholders after paying all the liabilities. Residual interest in the total asset excluding all the liabilities. Then it is in the nature of equity. And there is no contractual obligation to pay cash. In equity, there is no contractual obligation that they had to pay cash. And in case of convertible instruments, settlement through own equity shares and if the fixed to fixed criteria meets. For convertible instruments means they have an option to convert in future, and if settlement is happen through own equity shares and fixed to fixed criteria meets, then it is a case of equity. Then initially it should be recognized at fair value and subsequently there is no measurements. In equity and in the nature of liability, initially it should be recognized at fair value and subsequently it should be recognized at fair value, but it is recognized through. Now transaction cost. What is transaction cost? Transaction cost is an incremental cost. If the transaction does not happen, there is no case of transaction cost. So transaction cost incur only when the transaction happens. So transaction cost is the incremental cost which would have not been incurred if transaction does not happen. Example of transaction cost, legal cost. Legal cost when incur when if any property is purchased, stamp duty, when that transaction incurred, then registration charges, brokerage, if that transaction, commission, if transaction does not happen, then these costs are also not incurred. Now accounting of transaction cost, how accounting is to be done? Transaction cost shall be charged to profit and loss account and transaction cost will not form the part of good. That is transaction cost P&L account debit to bank. Now we will discussing the example of transaction cost. Suppose G Limited acquired one of the subsidiary of M Limited. M Limited has two subsidiaries, R Limited and S Limited, and G Limited acquired one of the subsidiary of M Limited, that is S Limited, at rupees 100 crores. So revised structure is G Limited is having merged with S Limited and M Limited is having now M Limited and its subsidiary R Limited, and G Limited will get merged with invested in S Limited. So now there is a two separate legal entity is there, that is G Limited and S Limited are two separate legal entity. So now they will prepare standalone financials of their own and also the consolidated financial statement. So J Limited is if they have having the controlling power, then he will prepare the financial statement, standalone financial statement, and he is also prepare the consolidated financial statement. So in standalone financial statement, if he is acquiring S Limited, then he will make an investment in its books as investment in S Limited account debit to bank by rupees 100 crores. And if he is incurring any transaction cost, means suppose he is incurring a transaction cost of 10 crore, so that transaction cost is to be capitalized in the standalone financial statement of G Limited in the value of the investment in S Limited. So he will make another entry, investment in S Limited account debit by rupees 10 crores to bank account, because this amount is related to the transaction cost which is to be incurred if the transaction happens. So it should be capitalized with the value of the investments in case of In case of standalone financial statement as per Ind AS 27. In case of consolidated financial statement, they will apply the accounting, business combination accounting, because there is two separate legal entities, G Limited and S Limited. Even the G Limited acquired S Limited, but there is existence of that entity also. So applying business combination accounting in consolidated financial statement, so they will recognize the goodwill, that is purchase consideration, what they pay, that is 100 crore. They will acquire all the assets and liabilities, that is net asset acquired by rupees 60 crores at fair value, and the differential amount will be the goodwill, that is 40 crore. So they will apply business accounting in these case. In consolidated financial statement, they will recognize the goodwill, who? The G Limited, because he is the acquirer in this case. Now he will do the another accounting, that is net asset acquired in his books, in the books of G Limited. When he is preparing the consolidated financial statement, he will all the assets acquired at fair value. He will recognize the goodwill to purchase consideration by rupees 100 crores. Net asset acquired account debit by 60 crores. Goodwill account debit by 40 crores to purchase consideration by 100 crores. Now, any transaction cost which they are incurring, it should be charged to profit and loss account in case of consolidated financial statement. When they are preparing consolidated financial statement, that transaction cost which they are capitalized in standalone financials, it should be charged to P&L in case in the CFS. So PL account debit by 10 crores to investment account by 10 crores. Some another examples of transaction cost also. The business combination, that is acquisition of legal entity. If they are acquiring a legal entity, then what happened? That if B Limited has three subsidiary, C Limited, D Limited, E Limited, which are the separate legal entity, and A Limited acquire one of the separate legal entity of B Limited, that is C Limited, by paying a purchase consideration of 100 crores, and he also in that transaction, the transaction cost also incurred, that is of rupees 10 crores. And the fair value of net asset acquired of C Limited is 80 crores, and book value of the net asset of C Limited is 60 crores. Now C Limited itself is having a separate legal entity, and if A Limited acquire the C Limited, one of the subsidiary of B Limited, then what happens? Then they will prepare a standalone financial statement, who the acquirer will prepare. In standalone financial statement, what A Limited do, they will make an investment in C Limited by rupees 110 crores. Why 110 crores? Because the transaction cost is to be capitalized in the value of the investment. So because there are two separate legal entity, A Limited is also a separate legal entity and C Limited is also a separate legal entity, and in this is the case of business combination. This is not a case of merger, or this is not a case of amalgamation. There is an existence of another C Limited also. It should not be abolished. So there is an existence of two separate legal entity after acquisition. Then in that case, A Limited, what he will do, he will make an investment in C Limited. He will show that he had invested in C Limited by rupees 110 crores, including the transaction cost. The transaction cost in this case is to be capitalized and in standalone financial statement of A Limited, and it should be reduced from bank account. So investment account debit by 110 crore to bank account. In consolidated financial statement of A Limited, they had to recognize the goodwill, that is purchase consideration minus net asset acquired at fair value. So purchase consideration is 100 crores, net asset acquired is 80 crores. So differential will be the 20 crores. Now general entry, what they prepare? A Limited net asset account debit, goodwill account debit to purchase consideration. Net asset is 80 crores, goodwill is 20 crores, purchase consideration is 100 crores, being asset acquired. And at the time of discharging that as purchase consideration, they will pass in another entry, that is purchase consideration account debit to bank. And in case of transaction cost, PL account debit to investment in C Limited by 10 crores. In consolidated financial statement, the transaction cost is to be charged to profit and loss account. Another case, in case of merger, when the business is not a separate legal entity. In that case, what happened? B Limited has three business, B1, B2 and B3. And if A Limited acquire one of the business of B Limited, that is B1, which is not a separate legal entity. After acquisition, there is no existence of the business of B1 business or B Limited, or totally merged with A Limited. Then in that case, what happens? It is there is, because after acquisition there is no existence of B Limited, so there is no existence of separate legal entity. So there is no case of business combination accounting. There is no requirement to prepare CFS. Now they will apply the business combination accounting in the standalone financial statement of A Limited. So in this case, what happened? In case of merger and amalgamation, what happened? The all the accounting entry, business combination accounting is to be done in the standalone financial statement only. But in other cases of business combination, like in case of separate legal entity or in any other case, the consolidated financial statement is required to be prepared. In a business combination is a concept of consolidated financial statement, but in case of merger and amalgamation, business combination accounting is applied in standalone financial statement. There is no requirement to prepare the consolidated financial statement, because in case of merger and amalgamation there is no existence of the separate legal entity, because that entity itself merged with the acquirer company. In merger and amalgamation case, apply the business combination accounting in the standalone financial statement, but in other cases of business combination, the accounting is to be done, the business combination accounting is to be done by preparing the consolidated financial statement. So this example is related to the merger. So applying business combination accounting is applied in the standalone financial statement itself of A Limited, because A Limited acquired one of the business of B Limited. The net asset acquired at fair value, that is 80 crores, recognized goodwill by the differential amount of purchase consideration minus net asset acquired, that is net asset acquired 80 crore, goodwill account debit 20 crore to purchase consideration at the time of acquisition. They pass these entry in the standalone financial statement, and they when they discharging their purchase consideration, they will pass an entry purchase consideration account debit to bank by 100 crores. And if any transaction cost incur at the time of doing the transaction, that transaction cost is to be charged to profit and loss account, that is PL account debit by 10 crores to bank account 10 crores. So applying business combination accounting in standalone financial statement in case of merger and amalgamation, but in case of other concepts of business combination, it should be done in the consolidated financial statement. Now if an entity acquire multiple acquisition, if they do the multiple acquisition in a 1 year, whether they apply the business combination at the end of the year, that is on 31st March, or they will do the business combination application on the day of acquisition, on the date of acquisition. X Limited form an organization, form a company on 1st April 2023, and on 30 June 2023 they acquire A Limited. X Limited acquire A Limited, and on 30th September they acquire B Limited, and on 31st December they will acquire a C Limited. These are the different dates of acquisition of different entities by X Limited. X Limited acquired A Limited, X Limited acquired B Limited, X Limited acquired C Limited on different dates of acquisition. Whether they apply business combination accounting on different dates when they acquire the another entity, or they apply at the end of the year, that is on 31st March 2024. No, they will apply the business combination on the date of acquisition itself. Even they acquire multiple acquisition in a single year, they will apply the business combination on the transaction by transaction base. On the base of transaction, when they do the transaction, they will apply the business combination accounting. So apply business combination on the date of acquisition, that is on, if they do the multiple acquisition in a single year, it doesn't matter, they will apply the business combination on the date of acquisition itself and not on the end of the financial year. So these combination accounting is done on respective dates separately and not as a whole in a year. So that is on 30 June if they acquire, they will apply business combination on 30 June itself. If they acquire on 30 September, they will apply the business combination on 30 September itself, and on if they acquire on 31st December, they will apply business combination on the date of 31st December itself. That is the effective date when they apply, when they have a controlling over the another entity. They apply the business combination. Now, these illustration is related to Ind AS 116 and Ind AS 103. Means if they acquire the asset of an organization, what happens in that case? Suppose B Limited has two separate legal entity, that is C Limited and D Limited. AI Limited acquires one of the separate legal entity, that is one of the subsidiary of B Limited, that is C Limited, which is a separate legal entity of B Limited, by paying a purchase consideration of 100. The fair value of net asset acquired of C Limited is 80 crores, including land of 10 crores. In order to transfer the land in the name of A Limited by C Limited, they incur some transaction costs like stamp duty and all by rupees 2 crores. Now what happened now? What is the accounting treatment of transaction cost? In Ind AS 16, what Ind AS 16 says, any transaction cost will be capitalized in the value of the asset. If it is a case of asset acquisition, where the asset is acquired more than 90% of the value, Ind AS 16 is applied in that case, if the asset is acquired. But in our example, it is not a case of asset acquisition. Asset is there, but the entity acquired the separate legal entity along with all the other assets, along with fixed assets and also the liability. In that case, if transaction cost incur, then Ind AS 103 is applied. Transaction cost shall be charged to profit and loss account in case of if they apply business combination account. And if it is a case of Ind AS 27, it should be capitalized with the value. As A Limited acquiring C Limited, which is a separate legal entity, and he is not acquiring only the asset of the company, he is also acquiring the liabilities, the deferred tax liabilities, all the assets of the entity C, which is a separate legal entity, and that existence of entity is still there. The existence does not cease. So in that case, it is a case of business combination and not an asset acquisition. The purpose of A Limited to acquire C Limited is the acquiring the business of C Limited. So it is a case of business combination and it is not a case of asset acquisition, and hence Ind AS 16 will not apply. It is a case of business combination, then Ind AS 103 will apply and transaction cost will be charged to profit and loss account in case of if they are preparing the consolidated financial statement. So in business combination, any transaction cost should be charged to P&L in CFS and NFS. These costs is to be capitalized in the value of. This example is related to 38 is applicable in this transaction in this example, and also Ind AS 103 will also apply. This is the acquisition of intangible asset. If the intention of the organization is to acquire the intangible assets of another entity, in order to acquire the intangible asset of that entity, and if they are paying for that asset, that is more than 90% of the value, if they are paying, then that is the case of asset acquisition. Asset acquisition means intangible asset acquisition, and that case in Ind AS 16 will not apply because they are acquiring the intangible asset. The intention of the organization to acquire another entity is to acquire the intangible assets of that organization. So in that case, Ind AS 38 will came into picture. So in that case 38 will apply, and if suppose this has to be explained with the help of example. PQR Limited acquired XYZ Limited on 30 June 2024. which includes intangible assets that comprise of wireless spectrum license. For these intangibles, PQR Limited required to make an additional one-time payment to the regulator to transfer the rights. In order to transfer the rights, they incur some cost, that is legal cost or stamp duty. Whether such additional payment to the regulator is an acquisition related cost. Now, this example is related to transaction cost if they are paying while they are acquiring the asset of the another entity, which is an intangible asset. So this is firstly, this is a case of asset acquisition. It is not a case of business combination. As in the question, it is not clear that XYZ Limited is a business. Itself is a business or not. We are framing our answer on assumption basis. That if we are assuming that if XYZ Limited is a business, is a separate legal entity, then in that case we will apply business combination 103. Transaction cost in that case is capitalized in the standalone financials, and transaction cost is charged to profit and loss in the consolidated. And if it is not a business, then we will apply Ind AS 38. Intention of the organization is to acquire only the asset of the organization. So it is a case of asset acquisition. So in that case, Ind AS 38 will apply, and transaction cost is to be capitalized in the standalone financial statement in the value of it. In the upcoming video, we will discuss some more concepts related to steps in the acquisition accounting. Another method of business combination, that is the common control method, we are left to discuss. Thanking you for watching my video. Please like, share, subscribe my channel.